What's good, YouTube? It's your boy Zay, and welcome back to my channel. Now, today is a very special episode of Setup Sunday. Now, a while back, I did discontinue the series, but today I wanted to bring it back just for a special episode because as we get into the end of this year, there's a couple of things that I'm seeing that I personally want to share with folks that I feel can get you ready for not only the ending of this year, but heading into 2023. So today I'm going to share a couple of special indicators that I use and tell you or walk you through why I think the bear market rally has a little bit further to go, as well as once we get through this bear market rally, you need to really keep your head on a swivel and watch for a potential turnaround. So with that being said, do not forget to press that like button, as well as subscribe to the channel if you like the information that I'm giving. It's always appreciated. So with that being said, we're going to just jump right into it. This isn't going to be a super long video. We're going to get through these indicators, kind of go through the explanation, and then I'll let you guys be the judge, right? Because I'm only here to just share my thoughts and opinions. I'm not here trying to sway anybody, but I think there's some things that you need to pay attention to. So with that being said, we're going to go ahead and share my screen. We're going to get right into the video. So let's go ahead and bring this up here. So the very first thing that we're going to look at is the actual market, so the SPX, right? So currently we're at 39.65. Now, the way we're looking at this is on a monthly chart, right? So just imagine that we're now, well, not even just imagine, we do have 2 weeks left, 2 weeks left in November, or about a week and a half left in November. And currently the market is up 2.4%. Now, if you were to put this or go down to a weekly time frame, you can see that since we've made our bottom in early October, right here at 34.91, we've been on a bit of a rally here. Now, there's a couple of things that you do need to point out when it comes to the SPX is that we have a couple of gaps or voids here, right? So you got this one up here at 4,200. And I'm gonna drag this all the way out to January 23, right? So you got this little area from what's that 42, about 40, let's just say 4230 to 4200, right? You have basically a gap there. That's a big gap. Then when you go down to the 1 day, there's going to be another gap that I want us to key in on, which is going to be right here, right? When we gap down here, so that gap goes from the close of 41, about 41.10 down to the open, which was 40.37. So these are two big areas that the market could definitely be targeting, right? To the upside. And that's why I feel like the very first thing of why I feel like we have a little bit more juice is because we most likely, or the market most likely wants to take either these highs or these highs before, you know, this, I guess you could say, buy model would be over. So these are going to be our two target areas. Now, the things that I want to show you that support this theory, I'm going to walk you through the couple of items that support this theory. The very first thing we're going to start with as far as a push up and then what we need to be watching or watch for the turnaround is we're going to start with the dollar, the DXY. This is not your typical indicator that most people probably thought I was talking about. Most people will watch this and say, hey, I thought you was talking about a MACD, RSI, something like that. But no, we're going to use other indicators that help support this thesis, right? The very first one is the dollar. We look at the DXY, right? And when you look at the DXY, let's bring this in. And as you can see, this past week, we only were up 0.5%. But the biggest thing that I want you to notice is that from a technical perspective, we were on this bull rally, right? On this bull rally, and eventually we topped out. Now, when you top out, you're going to look for where's the next set of lows that you want to attack. Well, the first set was right here, right under this like 108, basically 107 and this top. So we, as you can see from a weekly perspective, we straight slammed through and took these lows out. Now, if this was going to be, say, the low or whatever for the dollar, you would have expected us to kind of retrace and push even higher. We didn't, which gives me the sign that we may even want to attack these lows, which is at 104.63, and brings you right back to this market structure. Now, if I change this to a line chart, everybody knows I love line charts. You can see how this bounce and this bounce basically failed. So if you get one more leg down and the dollar does go attack, say, these lows of this 105 and come down to that 104 we're talking about, you know, it gives you a nice structure of a market breakdown. And when the dollar goes down, this is supportive of the market rallying. So this was the first sign, or one of the first signs of first signs that pointed to we could continue to rally. But then from there, once the dollar does get to this area, we want to watch out for it to start to base out and then turn around and truly retrace back up and clean up some of these gaps that it has. So if I go to a 1 day or daily chart, you can see how that there's definitely some fair value gaps and a few other type of gaps up in this area. So if the dollar were to break down and test these lows or break these lows and then start to form some structure over the next couple of days, under here, we can see it start to retrace and go back for that 109. So that's the first indicator that points to me that if we continue to watch this, the dollar is showing weakness, which means the rally could continue through at least the end of November. But then once we get into December, watch the dollar to see if it starts basing out and for it to then start to retrace. And that could cause a pullback in December. So that's sign number one, the dollar, right? You want to pay attention to the dollar. And this is one of the indicators, right? The next indicator that we're paying attention to, or that I'm paying attention to, is the bond market, right? So the bond market is another great indicator as far as how far can the rally go and when can we expect a turnaround. So if you look at TLT, this is one of the indicators that I use. You can see that has basically formed a nice bottoming. We had basically a capitulation bottom here after, I want to say maybe 10 weeks of selling. You got a nice strong green candle here. You have one more pullback. And now, as you can see, if I change this to the line chart, it looks like the double bottom is in and we're starting to turn around, right? Now, if the bond market rallies, once again, this is supportive of stocks because the bond market is one of those, as most people say, it's the real indicator, right? It's real indicator for risk. Bond market traders are usually smarter than equity traders and so forth. So what we want to see from the bond market is a sustained rally, and how far can this rally go? So if we look at the bond market in TLT, I would say that, the bond market is in a great place. Well, I won't say a great place because it's down like 30 some odd percent, but just this bottoming, right? This bottoming process is supportive of the rally. Now, if we see TLT and bonds start to turn around, then we know, okay, this rally is not real and it was just a pump fake, and that we could be headed down into the rest of the year. So when it comes to the bonds and TLT, you want to keep this on your radar, right? And I'm changing this to a monthly, so now you can see in that, okay, we could finish strong in November, but if we see bonds start to turn around in December, kind of like it did right here, right? Like it got a pump in July and then it turned around in August. That's what you want to pay attention to. Do we finish strong in November, but then December, do we start to turn? And if we start to turn, that's not a good sign for the market. So again, very supportive of our idea that the market could keep rallying, but then eventually we want to watch out for a turn. The next indicator is the HYG. So these are high yield corporate bonds, right? Again, another good indicator of, can this stock market rally sustain itself? When you look at this from a monthly perspective, you can see that we are in a volume gap right here and that we could possibly even push up a little bit further. Once again, very supportive for a short-term rally, but then when we look at the longer term, it has a gap down here. So we would expect that it will come back and turn around. And then again, that's not a good sign for the market. So we want to watch for stress in the bond market. Right now, we're not seeing too heavy signs of stress in the bond market, but when it does come, that'll be a sign that the market is turning around. So this is another indicator. Well, I call this an indicator. Some people would say it's a ticker. To me, this is an indicator, right? Or how I use it is an indicator. So personally, when I look at it from a weekly, the turnaround still looks good. And it looks as if the HYG could probably have one more week of rally in it. And as you can see, we got some gaps up here that if there was going to be some possible targets for the HYG, I could possibly see it target this area, which is roughly 76.95 to about 76.36. Again, supportive of a short-term rally, but then when we get there, head on a swivel, right? And so as we go through the bonds, that gets me back into the next indicator, yields, right? Now I'm going to skip over TBT, but I'm going to go to the US 2-year and the US 10-year. Now, if you don't track these, you definitely should, because the US 2-year is very indicative of what the federal funds rate should be. And that's been one of the drivers of the market this year, is the yields. When yields have been going crazy, market's been coming down, markets have cooled or went sideways, or when yields have cooled off and went sideways, the market's been able to do a rally. Now, personally, I think the yields are about to go into a little bit of a corrective phase, right? So when you look at, say, this US 2-year, as you can see, this thing is very extended, right? I mean, the US 2 years, I mean, look at this. It's just extended, crazy run. Now, it is very possible that as we finish the month of November, we could see a little bit more of a give back in the US 2-year, right? And what does that do? That would be supportive of tech, right? When yields come down, tech can typically rally. So if we just get, say, another pullback in the yields for it to come target, say, 4%, or maybe even just grab these lows right here at 4.2, come touch this moving average at about 4.25. So really what I'm looking for is, can the US 2-year turn around and come back down to about 4.25? If that can happen, that would be very supportive of a tech rally. And as you can see from a structure perspective, we do have some support right here. Oh, I'm sorry. Support right there. So this, again, this is the area we want to see it break. Can it break this 435, take these lows and start to form a little bit of a base here at 425 before it, you know, reverses? Again, this move here, if bar or if yields were to break down, will be very supportive of a stock market rally. But then when it rallies back up, you know, you're going to get that correction, right? And so that's the US 2-year. On a side note, you also got to watch the US 10-year. That is another yield that's showing me weakness right now. So if I look at the weekly, you could, you know, most traders might say, hey, this is the form of a double top. And then now next week, we could get a little bit more of a breakdown. Now, I don't know if the 10-year is going to break down this far as the 3.2. But when I open it up, I definitely could see us coming down and trying to target these lows at 3.5. You have a gap right here. And then you also have a high here. So at least going to target this 3.5 area could be possible. And again, that is very supportive of a stock market rally. But then afterwards, we have to put our head on a swivel, because going into December, we have our FOMC meeting. And if Powell comes out hawkish, all of this stuff could turn around. And that's what would cause the turnaround in the yields, in the dollar, is that if Powell comes out hawkish, those things would turn around, i.e. the market could drop. So right now, supportive in the short term for maybe another week or two. But then after that, we need to pay attention and watch these indicators or these tickers to see, do they start to build base out and turn around? Now, got a couple more to go through, and then we'll wrap this up. The last one, or one of the few last ones, is the VIX. Now, when you look at the VIX has been on a what, 1, 2, 3, 4, 5, 6 week losing streak, essentially. And if you look at this chart very closely, you have, again, gaps, right? So you have this gap that we created when we went on our last, when we created our last little pullback, right? So this was about August and through September. So when we had that pullback August through September, this was a gap we created, and we actually created some others, but as you can see, we've now come back and clean those gaps up. So we have one last gap that we may want to come down and get, which again, if the VIX comes down, is going to be supportive of a stock market rally. And if you look at where this gap is and look at what the VIX could be targeting, it'd be 22 to about 20.59. Now, if you've been paying attention to the stock market this year, when the VIX has gotten to 20 or under 20, that has been a good time to typically sell and look for protection in the market. And when it's gotten above, say, 32 to 35, that's been a good time to start buying and looking for swings in the market. So this, again, technically is showing me that it's supportive of another week or so rally, but then afterwards, we need to start looking for it to base out and turn around, because that's what it's done every time it's gotten down here to 20. It's based out, turned around, and that usually signals a peak in the market. If I go to the 1 day or the daily, you can truly see this gap And so you may definitely want to pay attention to when the VIX enters this gap. How is the market performing? Where are we? What, those type of things. But another indicator pointing towards, hey, we have some supportive data showing that, hey, the market can continue to rally. And as you can see, look at this big drawdown, weak bounce. We may get one more drawdown, right? That's going to give you this look right here. Let me give you a trend line. And we come down, and let's just say this was, that gives us our weak rally. We fill the gap. And then going into December and the new year, we're looking for the VIX to do something like that, right? Build a base and then take off. So supportive for a little bit of a rally, but then watch for the turnaround, right? Watch for the turnaround. So that's the VIX. That's the indicator that I'm watching there. Now, the last three that we're going to go through are the special ones that I really feel give you a really good insight to when markets are at potential turning points. The very first one is this indicator, which is S&P 500 stocks above the 50-day average. Now, when you look at this, the last time we peaked out was around August 8th, right? And that's when we peaked out from the summer rally, right? And if I go here, June 13th, mark that low, and then we rallied through. Same thing is happening. September 26th is marking a low, and we have been rallying essentially through this period. We've been getting our end of the year kind of early rally. Excuse me. Now, what is supportive is that there's a gap right here. Now, if we get one more push from the market and we fill this gap, then again, you need to have your head on a swivel, because every time this indicator has gotten up here, it has marked potential tops in the market or potential reversals. And if you don't believe me, we'll go through and look. This was the August 8th, August 15th. If we look at the charts, which we will, or for the S&P, August 8th, that week of the 15th, marked the peak. That's when we made our August high. If you go through and look here, around April 21 of 2021, that is when we made another peak in the stock market in 2021. And I mean, all of these will represent significant peaks. This is November. This is January. This is right around March. This is April, before we started our last slide. This one right here is the September one. So this is a really good indicator right here that when we get up into this area, you may want to, again, start to look for a potential turnaround. So this is another indicator that I'm watching that is starting to get a bit extreme and pointing to signs that, hey, this rally could be coming to an end and potentially starting to turn around. On the same note, I'm going to give you the second one, which is S&P 500 stocks above the 200-day average, right? And again, you can see like we formed a nice double bottom right here, right? Formed a very nice double bottom. And essentially, you can see it as well. When we are now reaching this 200-day moving average on this indicator, and the last time we got up into these peak areas just so happens to be when the market peaked, right? So when we look at this time period, this was March 28th. March 28th is when we peaked after the first Fed rate hike rally. When you look at this area here, when we got above our moving average, this was August 15th. We peaked again and we turned around. So if we get into here and we start peaking out, right, hitting resistance, and there's also this little small volume gap up in here, which again is supportive of maybe another week or two market rally, right? And then this thing ends up shooting up in here, kind of hitting its gap, but then reversing. And if I show you on a line chart, you can see a little bit better. Would be that, hey, we go ahead and make this last move up. We get this last burst. We get into here. And then eventually we want to look to see, does this start to turn around and come back down? And if so, this is, again, supportive of a short-term rally into the turnaround. So you need to pay attention to some of these tickers. And the very last indicator that I'm watching is the SPX PE index chart. Now, you can only find this ticker on stock charts. I went through this before on a couple of my Sativa Saturday episodes, but this is another indicator that I'm using of how far the stock market could possibly rally, and then the turnaround point. So as we look at this is showing us that the PE for the SPX is at about 20. Now, for the environment we're in, that's a little high. but it's also showing me that this moving average is sliding down, but could potentially be hit. So if the market rallies and we get to 21.45 or we hit this moving average, again, every time we've gotten into this area, you can see there's resistance here and then market starts to turn around. So if I just highlight 21 to 20, you got your peak here, right? And it turned around. We got up in this area and then it turned around and turned around. And so again, I'm looking for 21 to be that turnaround point. So if this chart gets to 21, right? So supportive for a short-term rally to 21. Then when we get to 21, do we start to see a turnaround to come back down to 18, 16, 17, which is more in line as far as the stock market PE when you're in a, raising rate environment or when rates are at 4 or 5%. The PE, the PE of the market is still a little elevated, and a lot of economists are looking for this to come back down to about 18, 17, which is average for a recessionary period. So again, as I continue to watch this indicator, I'm looking for a quick pop to 21. And then when we get to this 21, I'll look to see, do we start to turn around? Is there rejection and so forth? Because again, that could be a signal that the market has now peaked and that this bear market rally is over, and we're looking to, or we're going to start that reversal and start to turn around and continue our downtrend. So guys, that is all I have for you today. I've shared with you a couple of special indicators that I'm paying attention to. Feel free to use these. Also, drop a comment below which ones you like, which ones you didn't like, whether you agree, whether you disagree. Because at the end of the day, it's all about sharing perspectives, because nobody can truly predict the market, but I'm trying to share information that can help you stay ahead of moves. So again, if you like this video, don't forget to press the like button as well as subscribe to the channel. And I'll catch you guys on Saturday for the next episode of Sativa Saturday. And I appreciate you watching this special episode of Setup Sunday. And as usual, stay blessed. Peace out.